And welcome back. Thank you so much for joining me in today's video here. I want to talk about mortgage demand because mortgage demand has decreased to its lowest levels since 1997, according to a new report from the Mortgage Bankers Association, or the MBA, just reported today at the time of this video, which is the 26th of October here. I have a lot to share, so let's go ahead and dive right in. And of course, if you guys get any value in this video, then please hit the like button. I'd really appreciate that. All right, so this is according to the MBA. So total applications or total mortgage applications, which of course includes refis plus purchases, decreased 1.7% from the same week ago. I want to say one year ago. This is a decrease by 1.7% from 1 week ago. And this is for the week ending October 21st of this year. So again, if you guys follow the channel, you guys all know this, but total applications includes refis plus purchases. And they provide some details regarding that here as well. So the MBA's refi index, which is an index which measures the total number of applications for refis, actually increased by 0.1% from the previous week, but was down a whopping 86% from the same week 1 year ago. Also, their index here for the refis is at its lowest levels since the year of 2000. In other words, this is a 22-year low. Meanwhile, the unadjusted purchase index decreased 3% from last week, but was down a whopping 42% from the same week 1 year ago. What's also interesting to note regarding this is that the year-over-year decrease, again down by 42%, has been accelerating because last week it was actually down by 38%. Also, as a note right here, their purchase index has now decreased in 14 out of the last 17 weeks. How insane is that? Their index has only increased in 3 out of the last 17 weeks. Also, the demand for mortgage loans in order to buy houses right now are at the lowest levels since early parts of 2015. In other words, a 7-year low. Also, this year-over-year decrease, again down by 42% compared to 1 year ago, is the largest year-over-year decrease since 2010. Obviously, this decline in applications for home purchases is due to rising mortgage rates. And Joel Kahn, who's the MBA's vice president and also their deputy chief economist, had this to say. Mortgage rates increased for the 10th consecutive week, with a 30-year fixed rate mortgage reaching 7.16%, the highest rates since 2001. I have some news regarding rates here in just a little bit here. The ongoing trend of rising mortgage rates continues to depress mortgage application activity, which remained at slowest pace since 1997. Again, that's regarding total applications, which includes refis plus purchases. And purchase applications decreased by 2% compared to the previous week, to its slowest pace since 2015, as I mentioned. Also, this is over 40% behind last year's pace. In other words, the demand for mortgages in order to buy houses is down by 40% from last year. And he also stated the following here. Despite higher rates and lower overall application activity, there was a slight increase in FHA applications for home purchases, as FHA rates remained lower than conventional loan rates. So let me share that with you right now, which is kind of interesting to share this trend here. So as of today, which again is the 26th in the afternoon hours, the average 30-year fix is at 7.07%, and the year-to-date high was set last week at 7.37%. So rates have come down approximately 30 basis points since last week. But look at this, FHA, the average right now, again, these are for people with exceptional credit, these are average rates across the United States, is 6.62%. Quite a bit lower compared to an average 30-year fixed. And also compared to 1 year ago, have a look at this, because 1 year ago, rates were averaging at 3.25%. In other words, rates have increased about 382 basis points or 3.82 percentage points from 1 year ago. And rates have increased approximately 2 percentage points since August 1st of this year. Also, according to Investopedia.com, as of today, the average 30-year fix, again with people with exceptional credit, is 7.25%. And also at the time of this video, the yield on the 10-year US Treasury note is sitting at just over 4% right now. The MBA also mentioned their forecast for 2023 as well. Their forecasting is that they expect both economic and housing market weakness in 2023 to drive a 3% decline in purchase originations, while refinance volume is anticipated to decline by 24%. No surprises there, given the fact that rates are over 7%, and 1 year ago they were around 3%. And meanwhile, the refinance share of applications right now is sitting at 28.8% of total applications. Also, the share of adjustable rate mortgages, or ARMs, represented about 12.7% of total applications. This is vastly different compared to the start of this year, because back in January of this year, the share was around 3.1%. So in other words, the share of people submitting applications for ARMs has gone up more than 4 times since January of this year. And here's the reason why people are submitting applications for ARMs right now versus a 30-year fixed rate mortgage. According to the MBA, for a 30-year fixed rate mortgage with conforming loan balances, that means balances of less than $647,200. That's the loan balance. The rate there is averaging at 7.16% at the time of this report right here. But have a look at this, because for a 5/1 ARM, meaning that the rate is fixed for 5 years, then it becomes variable thereafter, the rate is averaging at 5.86% versus a 30-year fix at 7.16%. In other words, the spread between these rates right here, or these loans, is 1.3 percentage points. Compare that to January 1st of this year, or let's just call it January of this year. The spread was basically half of 1 point, or 0.5 percentage points. So that's why people are getting ARMs right now, because the rate is so much less than a 30-year fix. Again, 5.86% for a 5/1 ARM versus 7.16% for a 30-year fix. And by the way, like most reports, this is based on a sample size. So this report here is based on a sample size that covers approximately 75% of all US residential mortgage applications. And with that said, please comment below what your biggest takeaways from today's video. Also, if you guys got any value in this video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day, and look forward to seeing you on the next video.